Good day. Lots to talk about today, folks. We are going to be talking about the fun topics of the year. What it feels like people are talking about options, not stock options, but we're talking about actual option trading. I can't tell you how many people now are upset at 20% returns. Think about this. Their portfolio over the past few years have been returning north of 20%, and they're upset about it. Like, this is insane to me because why? They do an option trade for $200 and double their money to $400, and they think they can double their money consistently on just a few week process. And it's insane to me. And yes, in a raging bull market, that could make sense, but you can, and a majority of the time, you're losing money on options. People don't understand the full just complexity of how it works. And yes, I get it. There can be money to be made. I do options trading. It's great. It's fun, but it's not sustainable for a long-term strategy. But we first, folks, have to take a step back to understand what is options. I hear it all the time. So I'm going to tell you today what options are. And it's three core characteristics, talking about calls, then puts, and then talking about a contract. And then there are some other things, such as the price and time. So we're going to spend today talking about option trading. Now, I don't want you all going out there and doing option trading. I'm telling you, this stuff is risky, but I see people doing it time and time again. So it's my time to discuss it because people are doing it all day long on Robinhood. And yet again, they're thinking they could do this on $1 million portfolios. And listen, hey, if you got money to lose, go for it. If you're Bill Gates, I don't give a damn if you're making $1 million option trade. And oh, by the way, he probably is on Microsoft. So the idea there is there are two sides of options. There's betting, right? Or some would say taking a look at what you expect to happen, what you're hoping to happen, which is a call, making sure the investment actually goes up. If you buy a call, you're betting the price of the stock goes up versus buying a call, or excuse me, buying a put. When you buy a put, that is expecting for the stock market to go down. So these are core two different things where you can make money on either or. If you have a call, it's saying that I think the stock price is going to go up. Same inverse logic with a put, it goes down. As simple as that. You make money with a put when it drops in value. That's literally it. So why would anybody do that? Now, I've seen some very stupid option traders. These people have no clue what they're doing, and they'll buy a call option for a stock price at $50 a share. This is the stock current price. And then they'll buy a call option at $25. What the hell the point of that is? Because you could have just bought the stock outright for just double the price. That makes no sense. What makes sense is if you wanted to buy 100 shares of a stock at $50, that's going to cost you $5,000 versus maybe an option contract is trading at $5. You would only have to come out with 500. You spend 1/10 of the value, right? Buy 100 shares at its full price, it's 5,000. If you buy a contract, assuming it's $5 per contract, it's 500. So you paid for 1/10, and depending if you really think this thing is going to go up, that's where you start getting extreme returns. For example, let's say the price over whatever period of time you wanted the contract for, let's just call it 3 months, it went from $50 to $60. Okay? So if you bought the stock price outright, that $50 a share going up to 60, that $10 you make is a 20% increase. So your 5,000 is now worth 6,000, you made $1,000. That's pretty good over 3 months, might I say. But now, let's factor in if you did options. If you have an option contract, and you spend $5 on that contract, right? That's $500. If the stock price goes from 50 to 60, right? You made $1,000, but you only had to spend 500 and you made 1,000. You doubled your money. You actually, right? You technically didn't make the 1,000 because you had to pay 500, but you made 500 on a $500 investment. You doubled your money. That is the power of options. The idea that you can consistently do that. Keep in mind, I said there was a 20% increase, a 20% appreciation over the next 3 months. By the way, if you said that was over the next 3 years, because there are some options out there like Apple, they can go out multiple years. If you in fact did that, you wouldn't be spending $50, you might be spending $35 a share. By the way, each contract is 100 shares. So when you buy one contract, you have the right for 100 shares over whatever period of time that you want it. This is the power of options. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. And today we're talking about the basic concepts of option trading. And we see people doing it time and time again. And we do that for some clients at our firm. But it's not what you think. It's not the speculative aspect of just buying calls or buying puts and hoping for it to go up or down. Most of the time, people do it for protection. If you're sitting on $20, $30 million of NVIDIA or Apple or whatever the stock may be, well, you may want to buy a put to protect you for if the market goes down, you actually make money. So sometimes this is a strategy that people do. It's called a hedge. So that is actually what it's designed for, is a hedge to make sure that you are protected where you don't lose all your money. So here's the thing, you give up sometimes some of the appreciation for that. What do I mean? Well, it's costing you money to buy that put. You are spending some money to do that. So you're losing out. That's money you could have just kept and reinvested for it to go up. But you are comfortable taking some of your profits, some of what you would have made, to buy a put to protect you on the downside. This is important because I see a lot of people that actually leverage their portfolios. You think Jeff Bezos, even though he has been selling a lot of the stock, but do you think Jeff Bezos is seriously selling $150 billion to fund his wife's vanity project at Vogue or his multi-million-dollar wedding and all the stuff that he's doing? No, he's not selling it and paying 30% in taxes. He's not doing that. But what he is doing is he's borrowing on his own money at a 1, 2, maybe 3% rate. There was a point in time it was under 0.75%. Why the hell would he ever sell it and pay capital gains on that, especially if he feels the company's actually going to do well? Why would he pay a capital gains rate of 30% when he can borrow at 3, right? That's 30 years of interest. You get what I'm saying? And don't you think the stock could appreciate over the next 10 years? So the idea is, yes, or why the hell would you stay in that stock or investment? So these are core concepts of just the psychology of why options can make sense. So there is people like Jeff Bezos, or there are people out there that actually buy options to protect their core capital, their core investments, because they're borrowing on their large portfolios. So options is typically for the rich, for concentrated stock individuals. But now I'm seeing a lot more people investing their money in this, trying to grow their portfolio. And in that example I just gave of that $50 stock, now people are thinking it's so easy to make 100% on your options. Now, listen, for me, I love it when the market gets smashed in the face, drops 10, 20% like it did in April of 2025. That was a fantastic time for options. Money, you could be making money head over fist if you know what you're doing. But yet again, it is highly risky and speculative. Some of these options, you can do 1 week options up to multiple year options. That is extremely risky. This is where I typically tell people to relax, to chillax. And everything you're seeing on the news, all those things that you see on social media, which is most of the people now, that's all they see, of all these people bragging how their portfolio broke 100,000, how it made $1 million, how year to date they're up 68%. It's all great until it's not. These are the same people. And sometimes I'll comment on these people. I'm like, hey, bravo to you, because your portfolio was down 68% 2 months ago. And you clawed your way back to now breaking even for the year. Easy come, easy go. Do you understand that you can easily, your option contract that you write can easily be 50% less in just 1 or 2 days, depending on what happens in the stock market? And that's just with maybe a % or 2 move, depending on the length. So yet again, most people that do options are buying calls. And when you buy calls, you're betting that the investment that you're buying, the contract that you're buying, is going to go up in value. And when you're doing the puts, you're betting it's going to go down. And the problem with the put is you can have unlimited loss potential if it keeps going up and up and up and up and up. Who knows how high it can go up? So that's just a risk that's just not worth it. So there are ways, so there are strategies that you could use options in your portfolio. Heck, we love certain aspects of the portfolio, which we'll talk about after the break here. We'll discuss certain strategies out there that are fantastic for putting your money to work. And you can actually put like a buffer in your portfolio to help hedge volatility in the market. Folks, we'll be right back after a few words. Welcome back, folks. This is Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. And today we are talking about options. And I went over the simple concepts of call and puts, but let's take a step back. What is an option? An option is when you buy an option, you have the right to the stock. You own, it's a contract, literally, it's a contract to the right to the stock. And you own those stocks for that period of time. So the example I gave, if it's $50 a share and you say, hey, anything over $60 a share, I get the or anything over $50 a share, I get the profits on it. We have to pay for that rights. So if the price of that contract is $5, for example, well, each contract is 100 shares. So what's $5 times 100 shares? It's $500 is what it costs you for that contract. Then you tell it, hey, I want the rights for the 1 month, 3 month, 1 year, 2 years long. Now, the longer you go, the more expensive it is, right? Because a higher probability the stock price will go up, especially with news that comes out or whatever the case may be. But now you own the rights to that. So people are getting super excited about this. And I went over the idea of buying calls, puts, and betting it goes up, betting it goes down, and talking about how that works. And people are talking about it and saying they're making millions of dollars of this, and bravo. Talk all you want, but you only see the winning trades. You only see the winners out there. You don't see the losers. And the losers out there are crying about it. And they are, I mean, you literally, I pray they're crying about it. You had somebody a few years ago where somebody killed themselves over this out of a Robinhood account that they had. And that Robinhood account were the parent, and he just misread of how it looked. He thought that it was a negative $700,000. And he just didn't understand the settlement and how everything works on the Robinhood site. And the parents sued Robinhood. I don't know what happened with that. That should be a good Google search where I can find out the answer. I bet you there's some settlement there. But you can lose money on options. It's risky. High risk, high reward. And yes, depending on when you buy it, the reward could be huge. But do you really know how to do that? Options, you literally have to look at it every day. And it's funny, I laugh when somebody says they're a day trader. Like, what the hell are you trading? So options is literally rolling the dice. It's risky, and be careful and proceed with caution. Now, let's take a look at just other option strategies that are out there. There are some strategies that are out there, and I'll give you ones that we use a lot for our clients, and it's called like a buffer strategy. So what this is they own the right to an index. It could be the Qs, it could be S&P 500, large cap USA, whatever the case is, something big, powerful, and so on. Highly liquid, highly traded. So let's just say you own the S&P 500. Now there's a catch to it, right? So you have to put a cap on how much you can make. So you maybe participate maybe 70% of the market. But then you actually can put another option on the back end. So you have a call on the front end, and then on the back end, you have a put. Now the benefit of that is for the first 20% of a market loss, you are actually not participating in that. Now, it's all timed, right? If you do it today in the middle of the month or whatever it may be, well, he's not saying you can't lose 20% because these are all timed month to month, year to year, and so on. But the idea and the overall logic is that you can get 70% of the upside and you don't lose on the first 20% of the loss. This is the power of options. This is why some people are actually scared of options. But on the other hand, if you understand it, and this is why the rich get richer, because they understand, number one, complex situations, or number two, they have partners that they trust, that they vetted, that are not making commissions off you, that are actually get compensated for making sure your portfolio goes up, to make sure you are having the best possible options. No pun intended, best possible investment options available to you to help increase your portfolio and reduce your risk. This is why, folks, we're offering a free consultation where we're giving you 1 to 2 hours, 1 to 2 meetings of our time at no cost. And it doesn't matter where you are, we are located all across the country. So I'm having a tongue twister here. But the idea is we can help. Give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96 Falcon, like the bird, where we can help put together and give you a consultation to answer the questions that you have. Not just talking about options, not just trying to get this one product, but taking a look at your overall portfolio and gauging the risk you're taking, and are you being rewarded for the risk? Are you properly diversified? Are you taking advantage of what type of market cycle we're in and seeing the boom that we're experiencing right now in large cap growth and looking at if the tilts in your portfolio are accurate? And oh, by the way, there is so much other investments out there that we talk about being efficient. Markets are efficient. It makes sense. Hey, large cap growth is easy to do. Just get me Nvidia, Microsoft, Apple, Google. It's so easy to put that together, right? But when you start going to small caps, 2,000 of them, are those efficient markets? Like you have some zombie stocks that are out there that are literally losing billions of dollars a year, but they keep getting funding. They're not cash flowing positive at all. And guess what? Between Vanguard, State Street, and BlackRock, they have 30% of the market where if they just issue more stock, those three companies are gobbling up 30% where they can sell them instantly. Why? Because indexes have to own the whole universe, good or bad, profitable or not, and on the brink of bankruptcy or not. They have to own the whole universe of stock out there. Same thing for bonds, by the way. There's companies that just issue bonds because they know, number one, there's a bunch of idiots that are going to buy them. And number two, institutions have to buy it if, oh, by the way, they are indexes. This is why not all markets are efficient. And when you start putting tilts in the portfolio, for example, something as simple as a profitability tilt, it can make a lot of sense. You will really start to see the yield of the portfolio. There's periods of time where it outperforms profitability tilt versus non-profitability tilt by 8% annualized. Yeah, but people don't want to talk about that. They don't want to focus on that. That's too much work. That's too hard. But this is where professional management matters. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth, here on every week. And we are talking about all important topics of personal finance. And today we are started talking about options, and we're leading to now core portfolio management. And I just wanted to bring this up because I'm getting in Twitter exchanges or X exchanges, tweets. What do they call them now? They're not tweets, posts. That's soulless, right? But whatever. Getting these exchanges with people saying, "Oh, do you day trade?" They're always like private messaging me. I don't know what that's about, but they're private messaging me talking about how they're making all this money. Blows my mind when they do that because they are only showing what the winners are, and then they're saying, "Follow me on this newsletter. Pay me $2.99 a month." Like what the hell is that about? To follow them on the trades that they're doing. Options are not complicated. It is a derivative platform that you have to watch it daily. And who the hell wants to do that? Realistically, it's difficult. But all I'm trying to tell you is that you have to stick to your core portfolio. Because if you stretch out these option traders, and if you stretch them out over a 5-year period, they have struggled. And oh, by the way, outside of 2022, the market has only gone up. Even during COVID, where it had a little dip down and then went back up. I'm just mentioning that there are so many different variables here that people don't talk about. So just beware. Don't get upset as we are talking about somebody who in 2023 did very well, 2024 did very well, this year doing very well. They have an annualized return of 20% and they're not even happy. They're not happy. Think about that. They are not happy with a 20% return because they're talking about how their $275 option trade got 200%. Okay, but do you have the balls to do that on $1 million portfolio? Truly, do you have the balls to do that? Do you have the balls for that to drop 60% over a 3-day period? The odds is probably not. So you could say what you want and how amazing you are at option trading, how much money that you have made. But the reality is it's extremely difficult to do it on a consistent basis. And it's impossible. We haven't seen one person that has cracked the code. We've seen some people that got lucky. We've seen some people that have done 100 contracts and maybe had one that was 1,000 or 2,000% return. But the reality is it's extremely difficult. And most people buy high and sell low. So it's great when markets drop, but the reality is it's extremely difficult to do on a daily basis. This is why we say if you want help with a core portfolio, yes, who doesn't want 100% returns? And if you're getting 20% returns or the market's averaging 10% and you figure out all you really need is 7 to 8%, why are you going through all this hoo-ha? Why are you getting upset at yourself? Because you're only seeing social media out there. And I call some people out. I said, this doesn't even look real. Where you say that you have millions of dollars in your account. It looks like you adjusted it. Do not worry about what other people are doing. Winners focus on themselves and hold the standard of excellence based on what they need for success. So don't mess around with other people out there. Stay focused. We would love to help folks reach out. Our phone number is 855 963 2526. That's 855 96 Falcon, like the bird. Folks, that was a fast show.